Before you celebrate that profit, ATO is already waiting. Did you sell an investment property, shares, crypto, or make money on a business sale? There's one tax that quietly shows up after the win: capital gains tax, or CGT. Hi, I'm Molly, founder of Above Advisory and a certified tax accountant with over 15 years experience helping business owners navigate their tax and business. Today, I'm going to be sharing 6 key strategies on how you can legally minimize your capital gains tax. I can't tell you exactly how many clients come to me after they sold something and said, "Wait, Molly, how much tax do I really owe?" Because here's the truth. Most people don't actually know when CGT applies, they don't know how it's calculated, and they definitely don't know there are completely legal ways to reduce it. The difference between knowing the rules and not knowing them can literally cost you tens of thousands of dollars. So if you own a property, shares, crypto, or you're planning to sell a business one day, this video is for you. Make sure you're now subscribing to this channel so you won't miss on these valuable tips. Now, let's break it down in plain English. First up, what is capital gains tax? Capital gains tax is not a separate tax. It is part of your income tax. You pay capital gains tax when you sell an asset for more than what you initially paid for it. Basically, the profit you make is called capital gain. Common examples of assets that trigger CGT includes investment properties, shares, cryptocurrency, businesses, land, and some collectibles. Now, here's the key point. You only pay tax on the gain, which is basically your profit, not on the total sale price. Let's start with a simple example. Imagine you bought shares for $20,000. A few years later, you sell them for $35,000. That means you made a $15,000 capital gains. Now, here's where people panic. That $15,000 doesn't get taxed at some special CGT rate. It simply gets added to your taxable income for the year. So if you are already sitting in the 37% tax bracket, that gain could be taxed at 37%. And this is usually the moment clients look at me and say, "Wait, what? I have to pay that much back?" But here's the good news. Most people don't actually pay tax on the full capital gains, and that's where the strategy makes a huge difference. Let's talk about the big one, the 50% CGT discount. If you hold an asset for more than 12 months, you are generally qualified for 50% discount on the capital gain. This is one of the most common tax rules in Australia. So let's redo that example, okay? You made a $15,000 gain, but because you held the shares for more than a year, only $7,500 gets added to your taxable income now. That one decision, simply holding longer than 12 months, can literally cut your taxable gain in half. This is why timing matters so much in tax planning. But you have to be careful, as this discount only applies to individuals and not to the company structure, which I'll explain a bit more in detail. Now, let's talk about situations where you don't pay capital gains tax at all, which is great, right? The first and most generous one is your main residence exemption, your family home. If you buy your home, live in it as your genuine primary residence, and then sell it, you generally pay 0 capital gains tax. So if you bought your home for $600,000, lived in it for 10 years, and sold it for $1 million, that's $400,000 gain, which is typically tax-free, completely. That's called the main residence exemption. But it only applies if it was genuinely your home. Investment properties don't qualify. Another exemption applies to certain personal assets under $10,000. If you buy something like furniture or small boat for personal use and later sell it at a gain, exempt from CGT. But this does not apply to investment assets like shares or property. So no, your cryptocurrency doesn't suddenly become personal use because you like it. Now, if you are a small business owner, this is where things get really interesting. Australia has incredibly generous small business CGT concessions. In some cases, eligible business owners can significantly reduce or even completely eliminate capital gains tax when selling their business. There are multiple concessions available, including 50% reduction tied to active assets, retirement exemptions, long-term ownership exemptions, and rollover relief. Because this is a very complex area, I will be sharing and doing a very detailed video on CGT concessions for businesses, so make sure you are following this channel. Now, let's move into practical strategies everyday Australians can use to minimize CGT legally. The first strategy is quite simple. Don't rush to sell. Holding an asset for more than 12 months can automatically give you that 50% discount. Sometimes patience is literally worth thousands of dollars. The second strategy is offsetting capital losses. If you sold an investment at a loss, that loss can reduce your future capital gains. For example, if you made $20,000 profit on shares but lost $8,000 on crypto, you only pay tax on the net gains of $12,000. And if your losses are larger than your gains, you get to carry losses forward into future years. Smart investors sometimes strategically realize losses in high income years to reduce tax. This is also known as tax loss harvesting, and when used properly, it can be very effective. Next is timing your sale in a lower income year. Because capital gains get added to your income, your tax bracket matters. If you are earning $180,000 this year, but plan to take a break next year and earn $80,000, selling in the lower income year could dramatically reduce your tax you pay. Same asset, same gain, completely different tax outcome, you see? Another powerful strategy is contributing to your superannuation. If you make a large capital gain, you may be able to make a concessional super contribution to reduce your taxable income overall. For example, if you have a $30,000 taxable capital gain and you contribute $20,000 into your super within the contributions cap, your taxable incomes drop by $20,000. You've effectively shifted money into a lower tax environment where super is generally taxed at 15%, often much lower than personal tax rates. Then there's also that 6-year rule for property, which is widely misunderstood. If you move out of your home and rent it out, you may still be able to treat it as your main residence for up to 6 years. That means you could rent it out, generate income, and potentially still sell it at tax-free. But the rules are strict and timing is everything, so this is definitely not something to guess your way through. Ownership structure is another major factor. Who owns the asset matters, whether it's owned individually, jointly, through a trust, company, or SMSF can change the tax outcome significantly. For example, companies do not get the 50% CGT discount like I mentioned before. Individuals and trusts generally do. And here's the important part. You usually can't fix structured mistakes after you already purchased something. Planning needs to happen at the start. Now, let me show you how planning changes everything with a real-world style example. Let's say Sarah buys an investment property for $500,000 and sells it 5 years later for $750,000. That's a $250,000 gain. Because she held it for longer than 12 months, she qualified for the 50% discount. Now her taxable incomes dropped to $125,000. She also has $25,000 in carried forward capital losses from previous years. That reduces the taxable income to $100,000. Then she makes a $20,000 concessional super contribution. Now, only $80,000 gets added to her taxable income. See how planning changes everything? Without the strategy, she pays tax on $250,000. With strategy, she's taxed on $80,000. That's the power of tax planning. Moving on, let me quickly cover common mistakes I see all the time. Number 1. Selling just before hitting the 12-month mark and missing the discount. Number 2, not tracking your cost base. Things like renovation, stamp duty, and legal fees can help you reduce your capital gains, but only if you kept your records. Number 3, assuming transferring property to a family member avoids tax. No, it doesn't. CGT still applies at market value. And the biggest mistake of all, getting tax advice after the contract is signed. Once the sale is locked in, most planning opportunities disappear and they're out of the window. So here's the main takeaway. Capital gains tax isn't something to fear, it's something to plan for. Australia actually has very generous CGT rules right now compared to many other countries. But the key is timing, structure, proper record keeping, and planning before you sell. If you're thinking about selling an investment property or business, speak to a tax professional before signing anything. That one conversation can genuinely save you tens of thousands of dollars. If this video has helped you understand CGT more clearly, make sure you like and subscribe. And let me know in the comments what you'd like me to break down next. Whether it's property tax, trust, small business strategies. I'll see you in the next video. Bye for now.